Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 756A, and today's date is September 2nd, 2015, and the title of this episode is, The Next Economic Collapse Will Be So Horrific, It Will Be Talked About for Decades. Now, before we get started, I just want to make an announcement. Tomorrow, Thursday, I'll be uploading an interview with Rob Kirby. If you're on the X22 Report email alert system, I will send you an email. If you have signed up to the X22 Report Spotlight channel, YouTube should send you an email. If not, you can come right to YouTube, type in X22 Report Spotlight, and you'll be able to see the video there. Or you can come to the x22report.com site. You'll see the video on the right-hand side. Let's get right into the economic collapse financial news. Now, we've seen the stock market today. They pushed it up. We understand that Europe was able to be pushed up just a tiny bit. We see Asia, most of it was down. And we have to remember the stock market right now is down about 1,900 or so points from the beginning of this year. And they continually blame everything on China. It's China's fault. China's doing this. And at this point in time, we realize that the U.S. government central bankers, they're never going to take blame for anything. They're never going to admit to anything. We understand this. Going forward right now, the Chinese stock market is going to be closed for a national holiday for Thursday and Friday. And we'll see what the U.S. government does with the plunge protection team, high-frequency traders, because most likely they're going to try to pump this market up as best they possibly can for the Labor Day weekend. And they want everyone to go home, have a vacation on a high note. Because come next week, the fun will start once again. So we're going to have to watch that very carefully. And as we know, as we go forward, we're seeing a lot of these highs and lows. And the corporate media, the U.S. government, the central bankers, they're all out there telling us that, no, it's not our fault. We were in a recovery. Everything is absolutely fine. Don't worry about a thing. Just go to your barbecues, whatever you're going to do this weekend. We will take care of everything. But we're not going to do that. We're going to look at economic indicators, and we're going to see why these things are really starting to fall apart here. And we've been looking at this for quite a while now. And we see that ADP has come out with their numbers, their job numbers, and they missed expectations. And this is following a disappointing July, which tumbled down. So far, they've missed expectations for about 6 of the last 7 months. August ADP printed another miss of about 190,000 jobs when they were expecting about 200,000. And the manufacturing job growth is all related to automobiles. Because what we're seeing right now is these subprime people are the ones that are purchasing the cars. The government is a huge purchaser of cars. And all they did was prop up the manufacturing of automobiles. Can this be sustained? Absolutely not. A lot of the job growth, if you like to call it that, was driven by small businesses opposed to large businesses. And we have noticed that the jobs data has dropped year on year for the last months. So when you look back, you see that the job data is really ugly. We haven't gone anywhere. And the jobs that were created, they're all low-paying jobs. Because think about this for a second. Yesterday I reported on how these major banks are laying off tens of thousands of people. We know the energy sector has laid off hundreds of thousands of people. We know the retail sector has been laying off tens of thousands of people. Large corporations laying off tens of thousands of people. What jobs are these people getting? And we see right now that this strong jobs recovery is a complete lie. ECRI notes the sustained decline in the official jobless rate, now approaching the Fed's estimate of full employment, is a misleading indicator of labor market slack. The data shows that the so-called jobs recovery has been spearheaded by cheap labor, with no job gains, going disproportionately to the least educated and lowest paid workers. And as we know, those people who are going back to college, getting themselves into debt, then graduating, they cannot find work in their field. A lot of people are taking part-time work, still living with their parents. After dropping to 3-decade lows in the wake of the Great Recession, the employment population ratio has barely improved since the fall of 2013, reversing only about 1/5 of its decline from its pre-recession highs. Furthermore, as a breakdown of the EP ratio by education, it shows this modest improvement is an illusion. And it is an illusion. There is no improvement. And they keep saying, oh, wage growth, wage growth. Well, guess what? There is no wage growth here in the U.S. Unit labor costs dropped 1.4% in the second quarter, missing expectations of a 1.2 drop and falling to the lowest since the second quarter of 2014. Despite all the sound and fury and wage growth looming any minute now, it isn't. It's not happening. This is the first consecutive drop in unit labor costs since the fourth quarter of 2008. So those people who are working right now, sending out their resumes, and I know many people who are doing this right now, looking for other jobs, they cannot find work, and if they do, the pay is a little less than what they're earning. Doesn't make sense, does it? And what we're seeing right now is the ultra poor has doubled since 1996. They've been living on absolutely nothing. The number of U.S. residents who are now struggling to survive, they're doing it on $2 a day. It's unbelievable to think of this, placing 1.5 million households and 3 million children in the desperate economic situation. This is a recovery? What is a collapse going to look like? And of course, the United States government, the corporate media, they're continually trying to convince us that everything is fine. We're okay. But when we look at manufacturing, what do we see? Well, we see manufacturing declining. We see factory orders. They have crashed 14.7%. I mean, they pushed it up because Boeing had a big order. Since that time, factory orders are non-existent. New orders tumbled by 0.6 in July, plunging 6.9% year on year. This is the 9th month in a row of year-on-year drops and is without doubt signaling, you can say recession, you can say depression, I'm going to say a collapse. And when we look at this, you know where all these orders are coming from that they're talking about? They're from autos. The manufacturers are continually pumping out cars, channel stuffing the lots. The government stepping in, buying what, 38% of the autos from the American companies? This whole thing is a complete illusion to make you think everything is fine. They are basically doing whatever they possibly can to keep the illusion in front of everyone that we're in a recovery. But we're not. We are nowhere near any type of recovery whatsoever. This economy, this market, has been collapsing since 2008. So what we have is the illusion of their manipulated numbers, the government spending and borrowing as much as they possibly can to keep this economy up and running. The central bank is doing the same. while the people are sitting on the sidelines going, when is this going to improve? This is why people, when the Gallup did a poll saying the economy is going to get worse, 58% of the people said this. When we had the sponsored poll by the government, they're telling us that everything is fine. I mean, think about it here. And we know the next crisis is going to be much, much worse than 2008. Right now, the current global monetary system is basically based on debt. Now let's break this down and how this might play out here. According to the central bank, debt is money. And at the top of the debt pyramid are sovereign bonds, U.S. treasuries, German bonds, Japanese government bonds. These are the senior-most assets used as collateral for interbank loans and derivative trades. This is what makes up our financial system. So this time around, when this bubble completely bursts, it won't simply just affect a particular sector or area or any type of specific asset class. It will affect the entire system. That's what we're going to see happen right now. And like we saw back with the tech bubble, which took about 3 years for it to completely unwind, the next time around, it's going to take the same amount of time and it's going to be a lot worse. So when it hits, there's not going to be recovery that's going to happen very, very quickly. This bubble is not confined to one country. Globally, the bond bubble is about 100 trillion in size. The bubble is not confined to one asset class. The central banks will do everything they can to stop this from happening and basically try to keep everything propped up. But when the bubble bursts, they will basically have very serious problems here. And people are going to look at this and say, okay, who caused this to happen? And this is where the problem comes in. Because everyone realizes at this point that the central bank has been pumping all of this up, and everyone's going to point the finger at the central bank. And they don't want people to realize that it was them. So they're going to try to shift the blame, which we're seeing right now. I mean, right now this bubble is larger than anything the world has ever seen. And when you consider that these bonds are pledged as collateral for other securities, like derivatives, the full impact of this bond bubble is about $555 trillion. Let's put this into perspective. The credit default swap market that took down, took down the financial system in 2008 was about 50 trillion or so. Right now, it's 555 trillion. So you can see this is 100 times worse. Now, what do the central banks have done? What have they done to push this off? Well, the central banks cut interest rates to make these debts more serviceable. The central banks want target inflation because it makes the debts more serviceable and puts off the inevitable debt restructuring. The central banks are terrified of debt deflation because it would burst the bond bubble and bankrupt sovereign nations. So how is this going to play out? Well, when it hits, capital will fly into high-quality bonds, U.S. treasuries or so, and the bond market is basically going to accelerate and completely collapse on itself. And we're going to see a major disaster. Something that we haven't seen before. It will be so horrific. People will talk about this for decades. And we can see it's already starting. I mean, out in Sweden, they tried QE. It completely failed. And right now, banks, they're refusing to open savings accounts. And they're saying, if we're going to open up a savings account, we want everything. Your salary deposits, your savings, everything that we can get our hands on. So you just can't open up an account. You need to transfer everything over. And we're starting to see a lot of this where, the banks are looking for more and more to bring into the banking system, because as time goes on, what's going to happen? There's going to be bail-ins. Now, Christine Lagarde, she was at a conference in the Indonesian capital of Asia, and she was talking about the global economy, saying that there are many imbalances in the market in Asia, and this could spread to the rest of the world. And she's saying that right now the markets are so volatile that this whole thing could come down at any moment. That's basically what she's kind of saying. And at the same time, she's pointing the finger at China as the cause of all of this. And we know that China is not the cause. It's a symptom of what is happening here, because this whole thing was put into motion a long time ago, back in 1970. Actually, if we go further back to 1913, when the central bank was created, the Federal Reserve, which is not part of the government whatsoever. Going forward up to 1970, when we came off the gold standard, this whole thing was put into motion. And they knew at that point in time that this fiat system would only last for 40 to 45 years, and then it would collapse. Now, of course, they try to back this currency on with the petrodollar, but what happened was that didn't matter, because they continually created more and more money, non-stop. This is why we see an acceleration of this, because every time a fiat system collapses, we see a huge acceleration of printing, creation of money, or I should say currency. And other nations like Russia, China, BRIC systems, they realize that this dollar is going to collapse. And this is why they've been purchasing gold, not just since yesterday, for a very long time. They're separating themselves from everything that has to do with the private Western Central Bank. They're creating their own payment system. They're trading in their own currencies. Putin is preparing a bill that will dump the dollar in trade, because they know eventually this system's coming down. And we see the U.S. is continually putting pressure on Russia because of what's happening in Ukraine, and they realize eventually they're going to have to get into war. And they just imposed more sanctions on Russia. The U.S. Department of Commerce added new entities from Russia on other countries in its list of sanctions over Ukraine conflict. 39 people under 33 entries had been included in the entity list. Now, what's very interesting about this is that they include a MiG aircraft production manufacturer. And I think what they're trying to do is stop the sales of MiGs and other weapons to other countries right now. And this is why they impose sanctions, so other countries cannot deal with Russia. And Russia is saying that contracts that are already in existence, it will not affect them, but maybe it will affect new contracts. And Russia is out there saying that they will respond to the new U.S. sanctions somehow, some way, like they did last time with the food embargo. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.